take it straight to an expert as well on what really this means for the commodity trading space. Kishore Narne of Motilal Oswal is right here with us on the phone line from Mumbai. Kishore, good to have you on the show. Now, of course, this is clearly expanding the scope of commodity trading in India. But as Yash, my colleague, was talking about the settlement mechanism, that is the hybrid model that is going to be followed. How will that work and what does this mean?
Good evening, Nisha. I think the primary difference between the commodity markets and the equity markets in India is that the cash market is not present in commodity markets, though it is present, but it is not under SEBI regulation. So, of course, SEBI has to treat the futures contract as the underlying contract, unlike the equities where the cash scrip is actually treated as the underlying. So the settlement has to here result into delivery. So the option contracts will be allowed to devolve into future contracts at least 2-3 days before the expiry. So I think till that time, the option holder, either the writer or the buyer, will continue to hold and treat it as an option. But on that day, the next day onwards, the option will be converted into future, and the settlement of the futures position is already defined, and the settlement will happen as per the futures contract. So I think that's the typical difference here, and it is a good step and good measure that all the contracts, including the options in commodities, would eventually result in delivery as converted into futures.
And how many contracts are we really expecting under this?
I think as of now, in the circular, the SEBI has clearly said that it will allow both the exchanges one each commodity to be launched. But to be precise, what commodity could be launched, that is where they define that at least 1,000 crores average daily turnover for the non-agri commodities and at least 200 crores daily turnover for the agricultural commodities. But as of now, I think it will be one each on the exchanges. So my guess could be that probably we should be seeing gold as the first commodity to be launched, and probably on the agri front there could be soybean oil or something like that, which could be internationally benchmarked as well.
All right, and finally, Kishore, also who could be the major participants in this?
I think as of now, in the Indian commodity markets context, actually, the genuine hedgers and the corporates are not being really part of this market per se. It's largely being a speculator-driven market where very few commodities and very few corporates actually participate, because the primary disadvantage of hedging on the commodity markets using futures is that a huge amount of mark-to-market cash requirement and uncertain cash flows for the corporates. I think the options would remove that, the biggest hurdle which we had. And also options is a very efficient way of hedging the commodity risk. So I think the corporates are the primary beneficiaries which will be initially benefiting. And eventually, I think the benefits of this market should be reaching the smallest farmer who could be looking at hedging his price for the crop he has sown. Eventually, it should be happening either through farmer cooperatives or consolidating positions under by some of the farmer cooperatives. I think that is where the eventual goal is. But I think initially the corporates will jump in to hedge their